Welcome back. I think it's recording. I think my audio's on. Let's hope it is. Hopefully we don't get 20 minutes into this and then I realize something's not even recording. So without further ado, it's going to be so quick. I know I say that every single time. I'm not going to waste another second after this time spent telling you I'm not going to waste time. But here we go. Whole topic of today is how to make money doing absolutely nothing. Now, there's a caveat. There's a little section, a little catch here, but you don't have to absolutely do nothing, but you do have to change your behavior, and you do have to be aware of how you're going to be properly saving your money. They go hand in hand with, making money by doing nothing. You also have to understand how not to lose value of money you've already earned. So to cover all those things, we're going to touch on a few topics. We've gone over majority of them. Some might be new, some might be a little touch-up topics here and there. If they're brand new topics, I'll spend a little bit more time on them. But for the most part, we're just going to hit this thing full speed ahead, leave you with some good knowledge bombs here, some value, and then leave you with the assignment completely understood of what you guys should do in order to have complete understanding or complete familiarity with all these topics, just to bring everything home and everything to be remembered and right on the forefront of your memories for recollection's sake, not something that immediately after this video you just totally just forgot. Okay, so we're going to go over expenses. So hopefully you have at least 3 days of your expenditures recorded on an Excel sheet. I know for some of you that are walking through this one-on-one with me, we're doing Saturday, Sunday, Monday, and then we're extrapolating out from our Monday, the average for the rest of the weekdays. If you do have the time to do just a week of expenses, just pure data as it's coming in, you're recording it, great. If you can do it for a full month, even better. If you do it for a whole year and then you see this video, or if you can get your expenses from the previous year and you want to get it so accurately set up in such a way that this projection is going to be spot on for what you could actually see, then even better. So as much time as you want to put into sourcing that data, the more accurate your results and projections and models are going to be. Obviously, it goes without saying, everything is like that. It shouldn't be news to you, but the more accurate this data is that you start with, the more accurate your models and projections will be in the end. Great. Substitute goods. So as we look at our expenses and go, oh my gosh, that's insane. Why am I spending $45 at Blockbuster? Blockbuster doesn't even exist. Let's do a better example. Why am I spending $45 a week at Starbucks? How do we reduce that? Okay, I'm going to switch to an alternative caffeine drink. Let's say Caffeine and Me, or whatever one of these alternate caffeine drinks are. Since I've substituted that caffeine fix for another good, I now have to count that as a negative investment, or not a negative investment, a negative expense or a negative savings. So I don't want to be double counting savings. It's very easy to get into the kind of familiarity of just deducing deducting your expenses as you're adjusting costs and not remembering to then incur those costs as not savings but as additional expenses when you switch to a substitute good. So keep those things separate, keep them very clear that they are attached even though they are two different line items. We will come back to that, but I will show it to you in an example, but just good to have a kind of a core grip on it before we jump into it. Okay, number 3, investments. We'll look at 3 different investments that we can take a part in. Obviously, there's thousands of investments, from cryptocurrency to your neighbor's startup to your grandma's collection of XYZ, whatever it is, teapots, spoons, whatever it is. She needs money and she'll give you 10% back in a year, whatever it might be. There's endless, infinite amount of investments. New ones coming out every single day. Just other areas you can put your money into and you're expecting some sort of return. What we're looking at is almost 3 separate, distinctly different investment opportunities that are all, for the most part, guaranteed, are treated differently for tax purposes, and can be used almost as a benchmark for other investment opportunities. So if you guys later on start to do your net present value comparisons, looking at investment opportunities, these would be kind of reflective of a benchmark, so to speak, but not if you're looking at comparables within a specific industry or a specific investment type. Okay, moving on. Inflation, we're going to be using inflation at a 2.2% annual year over year inflation rate. Now, if you do look at the current inflation rate, you're going to see something tremendously different. That's okay. If you look over 10 years, you'll see it fluctuating from, in the low ones to the 4.2, some ridiculous numbers there, but we're averaging it out. We're looking at future expected inflation. We're calling 2.2 something reasonable, and we're going to go forward with that. We had to pick a number. We picked it. 2.2 as our inflation. Now, that's important because we're going to be adjusting our nominal investment returns, or our nominal rates of return on our investments. We're going to be adjusting that with our inflation rate of 2.2% to get our real investment returns, or our real rates. So whenever we're looking at anything from an investment standpoint, we would like to be comparing it, and especially when we're looking into it over time and we want to know in today's numbers, we want to be adjusting for that inflation over time, but real investment rate, okay? Real investment, which is nominal minus inflation for the most part. There's a slight differentiation when you include other numbers in there, but for the most part, we're going to look at your nominal rate minus your inflation rate, and that's what we're going with. Okay, time value of money. We just want to keep that kind of concept in the back of our minds as we're doing all of this. Recall, you might save you from making some sort of trivial mistake, but you need to recall that you are under the notion that $1 today is worth less than $1 tomorrow. Okay, that's pretty much the entirety of the time value of money theory. You have opportunity costs, you have inflation costs, you have all sorts of different risks associated with holding money that for the most part hold true in all cases. That if I gave you $1 right now and said, or if you lent me $1 and I said I'm going to pay it back to you in a year, don't worry, I'll give you $1 back. That $1 is not going to be able to buy you what it can today in a year from now. That's a whole notion of why interest is charged, because it's when there's opportunities to invest elsewhere that I could actually make more money than what I'm doing by lending you money. There's a risk that you might not pay it back to me, but that's different. And then there's a risk just of being outpaced by inflation. So that $1 in a year from now might only be able to buy me 98 cents worth of stuff in today's dollars. Okay, so that's time value of money. Please skip past all this. I hope you didn't just waste your time if you already know all this stuff. We're going to just jump right into the example here in a second. Disbursements, that's looking at the withdrawal process. So when you actually go to use these funds and you're withdrawing them based on whatever a savings vehicle it was in, also the investment type it was in, it's going to be treated differently. You might not even have access to it, or if you do want to take access of it, you might get a penalty fee on top of what you're going to be paying in additional taxes. So disbursement and planning for what you're going to be using the money for is entirely and very, very instrumental in how you should go about the actual process of setting up your savings. Okay, and then lastly, the savings vehicle. We're just going to be looking at two cases, that just a dichotic case of either using one or not using one, and the one that we would be using would be a Roth IRA. Just for this time period, majority of the demographics of the people watching this, it would make sense to use or utilize that vehicle. And then another case which might be important to look at is the no vehicle case, which would be almost like a brokerage account, a Robinhood account, Acorns. All these are brokerage accounts, more or less to speak of. And they are going to be treated as an unwrapped or a non-vehicle approach where there's no special tax treatment, so to speak, of those accounts other than, and let me iterate, the ones that come naturally with certain investment types, which would be like a capital gains rate. And we'll jump into that as well. That's it. We're wrapping all that into one assignment. We've talked about a majority of all these concepts. We've looked at other assignments or activities that you guys have done to utilize taxes, investment styles, substitute goods, expenses, etc., inflation. But now we're just bringing it all home. Okay. Let's go next, if we can get next slide here. You never know what's going to happen. Here we go. Okay, see it in action. Let's get to it. Okay, so right away in this Excel sheet, we have I'm projecting here all of my costs for a week, a single week. So I got groceries, Starbucks, gas, DoorDash, Amazon, other one, mud, water, other three. Okay. So it looks like other three was just an additional line item in case I wanted to include something else or substitute good. Other one, not quite sure what that was, but we'll just leave it in there. Mud water, we'll talk about that in a second. As you can see, the expense cut is looked at or reflected as a negative 100%, which is indicative of something that is a substitute good. I'm saying that because, as you can see in the example I'm going to be giving, or I am giving right now, is this Starbucks is costing me, let's see, well, it was costing me $36 a week. And right away I said, let me cut that out. So let me cut it entirely out. I'm going to cut it all the way out. 100%. Let me just keep an empty Starbucks cup, and you know what I'll do instead? Is I'll just pour some mud water into it. It gets me the same amount of caffeine. I'm not really picky about my coffee. I know some of you guys are diehards. You need to have this. It needs to be this temperature. It has to have this much, whatever, almond milk, camel milk, whatever it is. It has to be this, this, and that. And I have to get it with a green straw that kills at least 10 turtles. I understand. You need what you need. That's fine. For me, it doesn't really matter. I'm going to substitute it out. I'm going to save some money instead. So I cut that. I do 100% off of my Starbucks. So in this column, that's what it's adjusting. It's how much I'm actually spending on this item. So my new weekly budget is adjusting down to 0. And my savings is now $36. Okay, great. Now, what I wanted to show, and I was jumping off course there for a second, and let's get back to things. What I wanted to show is that my mud water is substituting the cost of my Starbucks. But if I had said I had saved $36 with my Starbucks and didn't account for the amount of money that I'm spending on the mud water, then that's not accurate. My mud water cost me $30 a month. Divide that by 4, $7.50 a week. So I'm accounting for this as a cost, but to calculate it into my savings, I need to attribute this negative 100 or negative 1 multiplier here to get it in as a negative 7 or an expenditure, so to speak. Reducing savings means you're spending more. Reducing expenditures means you're saving more. So I want to reduce my savings because I'm spending money here. I'm not spending more, so I'm still calculating the 36 minus the 750 to get me my 2850. Okay, so that's all accounted for, and I can visually see it. Now, you guys could structure this another way. That's fine, just as long as you make sure that your savings all add up to the correct number. When I give you numbers to test through, that they all equate to the same answer, so that I can clearly see easily that you guys are calculating these, your functions are proper, you know what's going on, and that all makes sense. Okay, going forward, we see that my monthly savings is $280, yearly savings from these expenditures, and my adjusted cost here. I adjusted my groceries, I adjusted down my DoorDash. Okay, Amazon, I adjusted what I'm spending on Amazon. Gas I left the same. Got it. Okay, so for the most part, those little adjustments, $12 here, $36 there, $15 there, $13 there, adds up to $70 a week, $280 a month, $3,360 a year, for a whopping $33,600 over 10 years. Now that's just saying I'm taking that money, I'm putting it into a bank account. Every month, $280, boom, I'm putting it, or it's not a bank account, let's say a piggy bank in my room. $280, boom, into a piggy bank. Over 10 years, I now have $33,600 in that bank. Now remember, that's 10 years from now, okay? So that value isn't gonna be buying me $33,600 worth of actual true value as we would see it today, but it's buying me $33,600 as it is seen from 10 years from today. So that value in today's terms would be reduced tremendously. Now, let's account for that. In a second here, let's jump down here. We see inflation. I'm telling you it's 2.2%. Okay, keep that in the back of your head. Write it down. Just keep track of it. It's important. We're looking at, this shouldn't be vehicles. This should be investments. Okay, so we're looking at 3 different investments, and it really should be 4. So we're going to call this checking. And that has a 0%. Okay. So we have our checkings at 0%, our savings account, or the savings rate from our bank, which is going to be 0.04%. No, that's not a typo. 0.04%. S&P 500 average year over year rate, we're going to go with 7.5% there over 10 years. So keep that 7.5%. We're going with the 10-year bond. Okay, we're looking at 1.68% annually. Okay, so these are the numbers across the board. These are your investments. Those are the 4 investment types. Great. Looking down here, we have checking, savings, our T bond. Good. We're doing 10 years. Let's keep that correct. Okay, our checking, savings, T bond, and our S&P 500. We had the rates reflected below as they were above in the example. You guys set this up however you wish. We have our inflation, the 2.2, and then we want to be calculating our real rate. You guys want to make sure that you're looking at real interest rates, okay? And how we can do that is we just subtract the real rate from the nominal rate, okay? Frequency, we're compounding monthly, so that's going to be 12. Years, we're looking over 10 years. Periods is frequency compounded times the years, 120, okay? Our payment is going to be our monthly payment because we're compounding monthly. We're also, that's not why, because we're compounding monthly. It's because we're distributing, or we're depositing, we're depositing so many D words. We're depositing $280 into our savings or investment type every month, okay? Now it's reflected as negative because we're spending that money into the investment. We're putting it in there. It's going from our pocket out. So it's almost like seen as an expense, but we're calling this expense an investment. Okay, so initially every payment is negative $280. We're starting with $0. That's fine. You guys need to calculate this real future value, okay? Which real meaning you're using the real rate as your rate. Now you do need to adjust it for the frequency, so don't forget, but do not fall into the trap of using that nominal interest rate, okay? That will not be correct. You will get the wrong numbers. Anyways, we're looking at the real future value. So we're looking at $30,130.17 being returned to us over 10 years if we just leave our money in our checkings account. Okay, great. What have we actually made in interest? That's saying I want to see what it is when we subtract out the payments. So, we made 120 payments of $280. I mean, we invested 120 times 280. So what is that when we subtract it out from the $30,000? We see that we've actually lost $3,469.83. And that is because, remember, all those payments accounted up to $33,600 over here at the 10 years in today's terms, but obviously it's less. And we see how much it's less because we actually lose $3,469.83 due to inflation. So that interest that we lost was all due to inflation. So the difference there being that, our money sat basically at $33,600 worth of it. It sat there and it became $30,130. So not a great return at all. We actually lost the value. And so in this case, there's actually something that you should do. In actually 3 of the 4 cases here, you're going to be making less than inflation. And in that case, you might say there's something actually more beneficial to do than to take on these investments, unless it's just to maintain, liquidity and not be invested into, other trivial things. But if you're just looking at pure value, there's definitely a play to be made here. I don't want to give it away because we're going to ask a question on it later, but you guys can maybe break it down right now what the question would be and probably what the answer would be as well. Very good. So going further rightward, we are looking at the difference in max and min. So just find your max and find your min, calculate what that is. So one investment, I'm going to be returned $10,779.20. Whereas in the worst investment, I'm losing $3,469.83. So what's the difference between there? So there's a swing based on where I actually put my money and save it, that I'm going to be making a difference of $14,249.03. Just meaning that purely on interest, and I'm not talking about the payment now. We'll get back to the payment and the totality of payment and the totals combined. So basically all my principal amount that I've invested are all the payments and my interest together as my total value. Okay, but looking just at this, it's $14,000. Oh, sorry, $14,000 in interest. Sorry, I didn't want to click on it and show you guys the formulas. That just gives it away. No structured vehicle. So this is when we're talking about the different vehicles. So we're looking at the Roth IRA, individual retirement account, and we're looking at the no structured vehicle, which is just those brokerage accounts. So we're saying whatever, Robinhood. Okay. So 10 years from now, when I go to actually take that money out of that account and use it, I'm going to be paying. So a checkings account, there's nothing structured around that. That just is there. I'm paying my income. But, you could say, yeah. Well, there you go. It should just be 0%. And sorry, we're fixing this on the fly. There was a little error there, and it doesn't adjust this because, anyways, since it was less than 0. But let's say 0%, and I'll tell you why. 0% because it's in a checkings account, meaning you've received that money, you've already paid taxes on it. You're not paying more taxes. You're not paying income on it. You didn't make anything. It's just $30,000. You just lost money. Okay. This second account here, your savings rate, you're making interest on your money, and that's actually income, and that would be accounted in your income level. Now we're saying you're making $86,500 a year as your income level. So let's just write that out. 86,500. That's your income. We're just going to say you have a 10-year job. That's what you're making. So and this is at year 10. So at year 10, you're making 86,500, which means when you actually go to pay this, we're going to be calling it 24,000 for this savings. Let's adjust this down because it's over time. We'll call it 18% to make it more realistic. That's why going over this a second time is more exact. We'll call that 18%. Great. Oops. Okay. 18%. When we go down and we look at the T-bond, that's 24%. Okay. 24% taxes because once again, that's after 10 years. You're making those payments every year. So let's adjust that down to an effective tax rate of 18% as well, okay? Great. Now, the capital gains rate, that's going to be more reflective of holding any investment type over a year. Since you're investing in the S&P 500, we actually have to be in a brokerage account. It's going to not be taxed until the disbursement. It's fine. We're going to be looking at that 15% gain over the 10-year period. So right away, let's jump into that 15%. And we see that our value is 42,762. Great. For the Roth IRA, we paid all of our taxes, so everything's being paid or taxed at a 0% rate, okay? Very good. And we see the differences here from 42,000 to 44,000 and some change. So there's a slight difference there in how you're actually getting taxed on it. It does make a difference, and you see it right there. Very good. Now, one thing to notate is that it's just going to be the interest that you're getting taxed on. So having this breakout in interest is very important. The interest being that you're not getting taxed on your actual payments. So into these accounts, it's not your actual, not the actual money value that you put in, but it's actual capital gains, and that's why it's called capital gains rate that you're getting taxed at. Okay. So it's going to be the 15% taxed against the 10,000. So it's going to be 1 minus 0.15 times 10,000. That's how much you're owing in taxes. So you could then subtract that from the real value and get your final value gained after taxes. Very good. Okay. looking at this, just more information on taxes. And really with all of that, we can go ahead and do all of our analysis work. So now you guys are done, and you can see right away from making a few changes, from saving $70 a week or $280 a month. So let's just look at this. From saving $70 a week, I've made $44,379 in 10 years. And that's adjusted for inflation. So, these numbers would look, if you want to make them more plump or more of a wow factor, you take out the adjustment for inflation. You could change these back to 24% instead of more of an effective rate, which is taking account of, you're paying these taxes as you're actually making more money over those 10 years. So you probably wouldn't be up in that 24% bracket, and it wouldn't be all taxed at the 24% bracket. So we're doing an effective rate of 18. This is just on the fly, approximated, but it would be about 16 to 19 based on what you're making. But we're saying that you're making $86,500 at year 10. We don't know any information on the years leading up to that. We would want that in order to more accurately calculate that. But for our sake, that's enough. That's all we need. And with that being said, let's wrap up the video. 27 minutes. That sounds good. That was not as quick as I wanted. I always want to bring these in under 30. I shoot for under 15. So I guess next time I'll shoot for under 7, and maybe we can get it under 15 minutes there. But hopefully that cleared everything up. Disbursements is what we're talking about with this Roth IRA and the no structured vehicle. That's very important. Inflation we talked about, time value of money we talked about, expenses we talked about, savings versus expenditures here we talked about, extrapolating out for your week we talked about, the different investment types we talked about, inflation covered. Great. I think everything I wanted to go over is here. You guys now have all the tools to do this yourself. I'd love to see them all built out like this. If you want to take the time, make it look great, good, make it more easily accessible and viewable from your perspective, you're more likely to actually use it in that case.